Welcome, market aficionados. Everybody knows the golden rule of trading. Everybody knows the best advices you can get. Avoid herd mentality, find your edge, be a contrarian, and so on. Everybody have seen the statistics, which show the only minority of traders are constantly profitable over longer periods. Okay, I know. The 80s are popular again, and mean deviation following strategies are plastered all over the internet. These secret trend following strategies are working great in a market with a strong direction. But basically, anything would work if you are on the right side of the trending market. Trend following is just another way to say, I don't know where the price is going. What is in a way related to these so-called strategies is more interesting. It is the crowd madness when it comes to parameters. Sanctity of 50, 200 moving averages is upheld with religious conviction, expressed by symbolism of golden cross, of dead cross. There are even official statistics, how many stocks are above and below 200-day moving average. What's so special about 50 or 200 days? I was born and grew up in a metric system. Seems natural, but is it? Do you really want to look at what the crowd is looking at and see something else? Something what a few can perceive? Looking at and following 50, 200 moving averages is just a pure superstition, having an enormous stronghold in many minds. What's so special about 14 on RSI? If you take daily chart, it is 2 weeks and 4 days worth of trading. It does not make any sense. How does it make sense on 14 hours or 14 weeks or 14 minutes? Well, I know. The formula is around 13, so may have some sense, but I will talk about that later. Look at this chart, RSI 14 daily. Nothing but the noise. One of the first tasks when working with a chart supposed to be elimination of any noise. So how does it help you? Someone in some markets observed that some periods are of significance, but you don't know why and don't know how and what for. The superstitious and mindless use of default, although often rounded parameters, is widespread. Why don't you use your birth date? Because you don't know anybody using it? Averages. Don't get me wrong. They have a place in reading charts. They provide very important reference. But so what you can do about the defaults? Well, you can add 100, 200, 150, 250, and you stay in that decimal system. You create a ribbon, or some call it rainbow, and it provides some visibility where the price is in relation to them. But take a look at indicators, two momentum indicators, RSI 14, Williams 14, noise, only noise, and so what you can do about it? There is a discipline called mathematics that is supplying abundance of answers to a chartist. If you want to be unique, like nobody else, contemplate uniqueness of numbers. And there are no more unique numbers than prime numbers. Take a look at the chart. Moving averages in prime numbers, they are much tighter. But they provide the same information as 50, 100, 200-day averages. But when you look at indicators, the pictures become more clear. You have RSI, you have Williams. Look what you can do with the Williams. Uptrend, downtrend, uptrend. You can use Andrews forks to check how far from the base it can go. However, there is a danger in prime numbers. And I know this from personal experience, although I don't comprehend fully why. I don't want to go to a deep end and sound woo. I don't want to travel some esoteric road. But I learned there is a meaning to every number. I only suspect that must be arising from relations between individual units. Every number has a structure. Anyway, overuse of prime numbers is like juggling balls flying in random directions. I use prime numbers with a caution, preferably when I need fractional picture and fast-moving settings. Here's an example I use on Keltner channels, and you can look for a moment at it. The other danger is that you don't want to set up a chart in fashion when you are thinking about yourself as unique. It becomes more about what's in you than what is in the chart. So what do? Mathematics are waiting ready with the answer. Whatever piece of chart you splash on your screen, you want to see every fracture, every cart in the train, every candle tree in a row. The problem is, not always is possible to see the whole structure on the chart. You have a glimpse into a fragment. What you need is a highly divisible number. After all, you wrestle with averages in that case. Before someone with good intention installs the decimal system with all tragic consequences to follow, there was a natural counting system based on 12. It is called duodecimal. There are a number of YouTube videos explaining duodecimal system. I highly recommend to watch them. I just want to say, duodecimal system is basically a map on which everything moves, propagates and creates relations across living things, galaxies and dimensions. It is how nature behaves. Market behaves like a biological system, inhaling and exhaling numbers, and I guess money. Market is way more natural than any organic food you can buy in your local grocery store. Duodecimal perspective is perfect to observe the market with satisfying insight into the price action. On Netflix Daily, there is green 72 days moving average. The price is rising beautifully. It's dropping through 144 and bouncing off 432 moving average. There is small break through 432. And it's coming back, it's nesting above those moving averages right here and running back up. This is Netflix Weekly. 432 weeks moving average. 144 days moving average. 72 weeks moving average is in green. I'm missing 288 just not to overload the chart visually. Now, look at the parameters. RSI 14, all but noise. Then if you put 144 days RSI on the chart, you have much clearer picture. Although, I don't like RSI. RSI is an outdated indicator. It's like driving a vintage car with carburetor and no seat belts. I prefer Williams indicators, but it's the same story. You have Williams percentage R, 14 days, nothing but the noise, and you can try to capture everything and play ping pong with it. But when you move to Williams, 144 days, that gives you some visibility of trends on momentum. Netflix Daily Advanced Decline Line. Same story. Clean picture, no noise. MACD, moving averages, convergence, divergence. You have all point marks. You can see the importance of the movement, not just some random jittery, I don't know, modern art. And some more examples. Boeing Daily, you can see the momentum expiring on the upside, on the downside. And right here, you see the divergence on MACD. L-Brands daily, Williams above. This crossing of the price through moving average is highly visible. MACD, MACD, moving averages, convergence, divergence. You have a clear picture when to enter and when to exit. Take a look at Qs weekly. The price is dancing off 144 weeks moving average. There's less visibility on that. That's too many weeks, I guess. Probably would need to be cut by half to have a better view. Same with MAC. And the last example, Nifty 50, Index India, Williams, running, still running. Look at MACD. This is the break from the base. India 50 will be running for a while.